Hello, my name is Brian Overby, and welcome to Options Guy TV. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes here. Today's date is Monday, January 22nd. We have a big earnings week, just to say the least. Netflix is kicking off the big cap tech earnings tomorrow after the close. And at the end of the week, we have a couple of companies that I'm going to be a little bit more interested in hearing from. IBM has quietly been making new highs, and they're going to be announcing on, let's see, it's either Wednesday or Thursday. We also have Tesla that's going to be announcing on Wednesday. Thursday, we have Intel, and we also have Visa. And then we go to the next week, and then that's when we get the big bangs. A lot of, or however you want to talk about the acronym you want to use, the Magnificent Seven. A lot of these companies are a part of. So you have Apple announcing, you have Meta announcing, you have Google or Alphabet announcing. They're all going to be announcing either the beginning or the very end of this month, or at the beginning of February. Meta is going to be announcing on the 1st, along with Apple, and so it started. So we're going to look at a few, and once again, whenever we talk about these speculation trades around earnings, it's not like it's a staple of your portfolio. One of the biggest things that I like to do with the options playbook is look at scenarios where we can kind of learn a lot about pricing, about the mechanisms of the strategies that are inside the playbook. And with earnings, you're trying to figure out what's happening with pricing of the option contracts as much as you are figuring out what direction you may think the underlying stock is going to go to. So in Netflix, we're going to start with a skip strike butterfly, and we're going to go far out of the money with that butterfly. We're going to flip a coin. I flipped a coin. We're going to say that their earnings are positive. Netflix has had real strong growth. They've been very resilient, battling off a lot of the competitors. Disney's came in with Disney Plus, and it just hasn't had the success. If you look at Disney stock price, it's battled, and Disney Plus wasn't the savior by any means. Apple has been struggling with the streaming wars, and Netflix just keeps chucking along, raising prices, and just basically blowing away the competition in the streaming wars. They're going to have more coming at them, and that's still an issue. People aren't just laying down. Amazon is starting to obviously do a lot of sporting events. That's going to be a struggle. It's an interesting space, but in the short term, over this earnings, over this week, we're going to get a little bit bullish, and we're going to do that in a very conservative fashion. We're going to have some risk on the trade. We're going to do a skip strike butterfly. We're going to go quite a bit out of the money on the trade, and that's how we're going to approach it. Now, as far as the markets are concerned, we keep trying to break through new highs in many of the indexes. S&P 500 today is up over 4,800. We went up and touched a most recent high, and we just keep chugging along. Now, one of the things that I find interesting about that is the fact that the Fed, the next meeting is going to be in about 9 days for the Fed. Not much expected in this next meeting. No rate cuts are expected. No rate increases are expected. There's about if I looked at the CME FedWatch tools, there's a 97% chance that they do nothing. Now in March, it's been very volatile, and as futures are determining these probabilities. But in March, we're seeing now about a 40% chance of a rate cut. A lot of people were thinking that this potential rate cut in March was driving the markets higher. But a month ago, if I take I'm just looking at it, just a quick peek at the CME FedWatch tool. 1 month ago today, there was a 75% chance of a 75.6% chance of a quarter point rate cut by the Fed. Now that's drifted south quickly, and there's only about a 40% chance. And obviously, this is based off of a lot of the economic news. We're going to get more news as we do week in and week out. PPI, CPI, we have a lot more news coming, but before this next meeting, which is January 31st, but obviously going all the way out to March, 40%. And this is why I find it interesting, is that rate cut was supposed to be the driver forward of the market, why the market was pushing on all-time highs. And now that probability is less than 50-50. So just the marketplace wants to go higher. That's my only reason. People have just been sitting on the sidelines for so long, and they have some capital, and I think they're just ready to start allocating it. So that's where the market is at. Now, let's run to options playbook, and let's look at the skip strike butterfly. Okay, so I've done a lot of butterflies around earnings. If you've watched some of the Option Guy TVs, and if you go back and look at especially the big cap tech, either butterflies or skip strike butterflies, it has a lot to do actually with the cost of the underlying stock, not necessarily the fundamentals. A little bit more expensive stock, it's a little bit easier to get a interesting skip strike butterfly off. So we're going to try that in NFLX this week. And don't forget, I'm still going to go back and look at PayPal, because on Friday we did do a bull call spread in PayPal. So we'll come back and look at that and see where that stock is at. But right now, on the skip strike butterfly, we are buying a call at strike A, selling a call at strike B. We're going to literally, and a lot of people call this a broken wing, or I hear it broken wing a lot more. But I like skip strike because that's literally what we're doing. We are skipping strike C, which would be a normal butterfly done for a net debit to the account, and buying strike D, equidistant. They're all equidistant all the way throughout, but we're buying that, and hence embedding a credit spread into the skip strike or into the butterfly, and hopefully bringing in enough of a credit from this short spread that we're embedding, the small or the short strike C, and buying the strike D, that it pays for the butterfly. And in our instance, I already looked at it and thought about what I want to do with NFLX and earnings announcements tomorrow. It will bring in a small credit, and we'll be able to go quite a bit out of the money. So this trade, to start with, it has a very interesting profit and loss graph from the point that you put it on to the point the earnings are announced, all the way up until that expiration date. It starts that it's going to be bearish, that you want it to go down, and eventually it becomes bullish. So the way I like to approach the skip strike butterfly, when I'm thinking of it, a lot of people think that you're modifying a butterfly. I like to say that we're modifying a short spread. And we'll look at this one once we get to the option chains. But what if you thought, well, ahead of earnings, I want to go way out of the money because I can get a lot of premium because volatility is pumped up because of the earnings announcement, and I sell strike C and buy strike D. What type of net credit could I bring into that account? And look at that and think of it that way, that I'm doing a short spread, and then say to myself, well, if the market does go up, well, gosh, now I got to manage that short spread. As expiration approaches, if I'm getting closer and closer to my short call, and obviously the market's going against me, every time that happens, that's going to hurt. I'm going to need time decay to really battle the fact that the stock is coming towards strike C or my short strike. If I have the skip strike butterfly on, I don't have to battle that. All I really have to worry about, and the biggest risk of the skip strike butterfly, is that the stock opens more than a double standard deviation move, which is possible. It's happened more than once in a lot of the mega cap tech stocks around earnings, so it has happened. And it opens way up at strike D, and I can't do anything about it whatsoever. And it just continues on up. So you get a double standard deviation move, and we'll talk a little bit more about what that means. And in that instance, then this trade is scary, and there's not much you can do about it because you're not going to have a lot of time because we're doing it on a very short-term basis. So we're doing the dance between the movement that we want, ideally, in the skip strike butterfly is for the market to go up, and the time decay battle, like how fast it goes up and how quickly we get some time decay to help us. Because if we're right on our forecast, we need option B, strike B here, to decay because we've sold 2 of them. We have a lot of time premium. We need that to go away to reach the maximum on our skip strike butterfly. Okay, so let's zoom back out. And here we go. And we're going to run over to the Trade Hawk software. And we're going to look at this trade. I have it all set up already. Oops, gosh, got it. That happened. Let me adjust this just a second here. Let's go back to the normal layout, and I will lock it. Okay. And let's lock this layout. Okay, so now here we are. We have Netflix at 484. It's up a smidge today, up $1.60 or 0.3%. And we're looking at, so to start with, and I've already done the math on this. If you look, well, I should probably explain the options grid here in the Trade Hawk software. I really like the way there's a lot of customization in the options grid in the Trade Hawk software. Right now it highlights where the at most at the money option contract is. We have the calls on this side. We have the puts on this side. We decided that we're going to be bullish on this trade. So we want to know where a 1 standard deviation move is, not to mention the fact that we're looking at the January 6th expiration. They're announcing tomorrow, which is Tuesday, which means we have 4 full days of trading that is still left. We got half a day today, and then we got 4 more days before these options expire. So if you look at this at 485, what's the long straddle trading for? What if I bought the call option and bought the put option? And you'll hear a lot of people quote this as the expected move around earnings. And it's fairly high. It's fairly substantial. We're looking at a 94% implied volatility, fairly high for Netflix. The historical vol is around 52%. And is going to be a 30. When I did the math on it and I looked at the midpoint, it was 39.23, $39.23, or very close to 8% move. That is the expected move, not the 1 standard deviation. So if you look at buying the call and buying the put, why is that important to people? Why do you hear it quoted on CNBC as the expected move around earnings? It's because this is what the marketplace is implying the move could be. It doesn't mean it's going to go up, doesn't mean it's going to go down. They're saying if people are buying the at the money long straddle, those people are betting the over, that it's going to go more than 40 points. And if they're selling it, those people are betting the under, that the move after their earnings is going to go under 40 points. Now, it's not perfect science. One of the biggest things is that they're announcing on Tuesday. The options don't expire until Friday. So this is the expected move up until that expiration date. But a lot of people just take it for granted that the only thing that matters is earnings. And there's one of the flaws that's in the math. But it does help us if the marketplace has the line in the sand right around $40 based off the price of the options and what people are willing to pay. Well, we want to go more than that because our risk in the skip strike butterfly is that it blows the numbers away and it gaps open and we don't have an opportunity to trade out of it. So 1 standard deviation move is a little bit more than the expected move. It is almost always, because the expected move has a possibility of happening. The 1 standard deviation move, you're talking about only a 16% chance of happening. Okay. So that's where we're going to start. Inside the Trade Hawk options grid, we highlight a one standard deviation move based off of the shading. And you can always double check that and look at kind of where the delta is at. So we're very close. In this instance, it could be a little bit higher, but around the 540 mark. But this delta right now is saying that we're at an 18% chance of that underlying stock finishing 1 cent in the money on the 535 strike. Well, that's would be good news if we finished right around the 535 strike. Anywhere between 535 and 545, we're going 10 points wide. I got to use both hands there. But we're going 10 points wide on our butterfly. Then our standard butterfly, we would buy the 555. So 535 we buy. Here's where our home run would be, right at the 545. Skip the 555, buy the 565. And now from here to there, you're adding another 30 points onto where the one standard deviation move is located, onto where almost double the expected move. We're talking, where's the stock at? 585. So if you added 80 onto the 485, so that would be double the expected move, right? And you add 80 to that, we're looking at 565. So that's actually right. I didn't even know it was going to work out that good. So if you did double the expected move and it blew the market away and you didn't have the chance to trade out of it, that's where your max risk is at, right at 565. So doing the math makes it interesting. And on top of it, if you're just dead wrong and the market goes down by the expected move, well, you're going to make your 43 cents on this trade. All right. So here's the trade. We are looking to buy the 535 January 26th strike call option. At the same time, sell 2 of the 545 same expiration call options, and then buy our protection, which is the 565 same expiration call option. Net credit, the midpoint right now is 46 cents. So we're doing this for a net credit of 43 cents to the account, which means that we just put a butterfly on for a credit. So if the market goes down or stays where it's at after earnings, that and all the options expire, we're going to make 43 cents on this trade. Much the same as approach as if we just sold a short call spread. Now, here's where it gets interesting. Okay, let's go in and let's send this into the what if calculator, which is a very good calculator inside the TradeHawk software. And this shows you how messed up sometimes a skip strike butterfly can be. Inside the options playbook, you see something that looks very similar to this, right? You see at expiration profit and loss graph. But to start with, here's where the underlying stock is at. As if you first put on this trade and you get no time decay and you have no decrease in implied volatility, which is expected usually after an earnings report, is you get volatility to go down. So when you do that, you see that to start with, if everything stayed the same, this is assuming no time decay to start with, or no crunch in implied volatility, and we went straight to our short strike. Look over here on the far side, you're going to see that this is assumed right here we'd be down around $250 on this trade. So I say this mainly because this is where the gap opening would kill us. If this happened and you had a crunch in implied volatility to start with, we would be down on the trade. If the market opened Wednesday morning, because they're announcing Tuesday after the close, and it opened right here, I would just want to get out. I would be like, I do not want that risk from basically this spot, which is 555 on up, of losing the maximum. I'm trying to make 47 cents here. The maximum I could lose is that short spread that we talked about, strike C to strike D, which in this instance is the 555 strike to the 565, right? The skip to strike is the 555. So that's $1,000. So we're risking $1,000 If we're dead wrong on the direction, we're going to make 47 cents. If the stock hangs around in this area, we're going to make 47 cents. We have the potential to make $1,000 if we got extremely lucky and it stopped right at our short strike. Our goal here is trying to make hundreds of dollars on our 1x2x1 skip strike butterfly on our unit. And as expiration approaches, implied volatility comes down. That moves this line up a little bit. Time decay starts eating away quickly on the option contracts. And within a day or two of expiration, we would like to be right in this area. So our ideal scenario is that the market opens half of the expected move, right in this area, right around here, and starts to drift up towards the precipice, the peak of the skip strike butterfly. Okay. All right, so that is how that's what the skip strike butterfly looks like. That's where we're at as far as this trade is concerned. Now, if you have any questions about it, you can obviously, if you're in the YouTube platform, you can set them in the chat box, and I'm happy to try to address them. But we will be back on Wednesday, so we'll know what this trade is, and we'll be able to look at this trade for Netflix. I don't know if I would adjust it. I don't plan on doing an adjustment on this trade. Like I said, the big risk would be that it opened two expected moves, 80 points or 16% on the open, and you didn't have time to get out of the trade. My biggest adjustment on the trade is to close it. Just say I didn't get it right. I'm going to close out the trade and I'm done. Maximum upside, if I'm looking, if I can get out for $500, I'm going to do that. I'm not going to hang around and try to make the maximum on this trade. If the market just stays where it's at, you're still not doing very bad on the trade. If you make $43 on a $1,000 investment, you're still looking at about 4%. So not too shabby on that trade. No, math is a little bit 0.04%. Less than almost 1%. Half of 1%. If I'm doing that trade. So 43 cents is the net credit to it. If the market stays where it's at or goes down, maximum we can make on the trade is 43 cents. We're hoping to make a few hundred, so we hope we get to move to the upside. So I still want to be right on the direction. I just don't want to get cremated on the trade by it doubling on me after that earnings announcement. Okay, so now let's go back and take a quick peek at PayPal, because we have a trade. We'll probably end up getting out of that trade by Wednesday, but we're going to look at PayPal right now. You see, these are the stocks that are going to be announcing earnings. PayPal is not going to announce earnings in the short term. They're going to go out until February. But we wanted to get long PayPal based off of the chart, based off of the fact that we got a little bit of a breakout in the chart. And the stock is down 62 cents on the day, but it had a fairly good day on Friday. So let me zoom in. This was last week's trading. This is where we were at, and we closed at the high on the 19th. And then as we went into the Friday's trade, so we're at 65 now, we're down at 61 cents. This was Thursday, the 18th, right? So here's on the 18th, the market was up, and then we saw a potential breakout in the underlying stock. We got all the ducks in a row. We got the 200-day, the 200-day moving average here. We got the 20-day moving average here, and I think this is the 50-day, the blue. So we had a breakout over the 200-day moving average here. And now we saw a solid up day on the 19th. And then we came back, and now here we are on Monday, and we are at 65.28. So we ran all the way up to 68 as a high. So this underlying is doing fine. Our trade is working out fine. We wanted to get above 68 by that expiration date. So you had a chance to get out, but I don't think I would have done it. It didn't hang there long enough We need a few more days of time decay, but if we get to our maximum on the trade, we definitely want to get out on it. We only spent $1 on it. If we can make $2 on it, then that's where our out point is at. And you let her ride is the way we look at the PayPal trade from Friday that we put on. We'll look at a little bit more closer on Wednesday. All right. So to summarize, we have earnings coming. We're going to look at a few earnings trades on Options Guy TV. They're not all going to be butterflies, but a few of them will be. And we're bullish on Netflix. We're kind of bullish, but still have a bearish feel to it with our skip strike butterfly. I guess that's the best way to say it. Skip strike butterfly is bullish with a bearish feel. So to start with, we'd like the market to open up, but we don't want it to blow the doors out. We want it to slowly start going towards our short strike. And the slower that it moves towards that strike, the better off we are. They're going to expire by this Friday. Net credit of 43 cents to the account. If we're dead wrong, the market goes down, we make 43 cents on our $1,000. And that's where we're at, or $43 total. All right. So I have Wayne. Wayne is asking a question. Wayne's a longtime listener. Has been around for quite a bit. I used to watch you over on the Ally platform. That's great news. I just found out about this new show. Great to see you again and running again. Well, great, Wayne. I'm glad that you found out. How did you find out, Wayne? Did you just find out? Maybe you follow me on Twitter. And if you did, that's all the time. And we're looking to actually on X, to use the new terminology, we're looking to eventually start streaming this this webinar via the X platform. And my handle is at Brian Overby. So if you give me a follow, that would be great. And you'll find out about everything that I'm doing within the Tradier Hub and also on the Options Playbook website. We're going to have a lot of new ads. Thank you, Wayne, for coming in and participating. And I'm sure we'll see you a lot going forward. Thanks for coming, everyone. See you this Wednesday. Very curious to see how the Netflix trade works out. So we'll see you Wednesday at 11 a.m. Eastern time. Make sure you subscribe, ring the bell so you get all the updates for when the next Options Guy TV is. Thanks for coming, everyone.